during the year which ended 31st of December 2022, which is automatically the current year, BD Limited disposed of an item of plant for a cash proceeds of 20 million, which has been credited in the revenue account. No other accounting entries was made. The plant had a cost of 39.7 million and accumulated depreciation of 15.86 million. So we are told any gain or loss on disposal of the plant should be included within the cost of sales. And then we are told it is a policy of the company to provide a full year depreciation in the year of the asset purchase and none in the year of disposal. So in that case, we are given information about an asset which was disposed. And there are two, I think, two adjustments we are going to make in relation to that, because we are told that this item of plant was sold for 20 million. Now, this 20 million, we are told, is included within the revenue. So it is obvious that once the company sells an asset, the amount received from the sale of asset, this should not be treated as part of the revenue, should not be treated as part of what? Of the sales. And therefore, this amount of 20 million, which was received from the disposal of the plant, 20 million, this one will be deducted from the revenue. This one will be deducted from the company's what? Revenue, because you are told this 20 million was included within the revenue. It was credited in the revenue account. It's also important for you to note, if you go to the requirement, to the trial balance, it is important for you to note that trial balance which you are given, if you check on the figures up there, you'll be able to see that those figures are in thousands of shillings. So therefore, for us to be consistent, we must work with all our figures in thousands of shillings. In any of the figure we have from the additional information, we must omit the last three zeros. We must omit the last three zeros. Yes, we must omit the last three zeros. The last three zeros. Yes, I'm trying to make some changes on my camera here. I don't think it is that clear, but it should be now. It should be now. It should be clear now. Should be clear. Should be clear. Yes, it should be clear. Should be clear. Okay. So therefore, what you have said is that this particular amount, we will deduct it from the revenue. Number two, anytime the company sells an asset, disposes an asset, you must compute whether the asset was, you must determine whether the asset was sold at a gain or at a loss. And actually, we do that by preparing an account which is called the disposal account. So therefore, what we need to do is basically to prepare the disposal account, and we determine whether this asset was disposed at a gain or at a loss. Although in this case, let's not use the disposal account. Let's not use this account. Let's just compute this directly. To compute the gain, or basically the loss on disposal of an asset, we take the sales proceeds. The sales proceeds, our asset was sold at how much? And then we deduct the net book value, which is the same with the carrying amount. We know that the net book value of an asset, this one is equal to the cost minus the accumulated depreciation. So if you get, after taking this minus this, if you get a positive figure is a gain, but if you get a negative figure here, if you get a negative figure is what? Is a loss. So therefore, let's compute this. We will take, yes. So today, I want us to start on this topic. The topic is the presentation of financial statements. And basically what you're going to cover as far as this topic is concerned is how the listed companies prepare their financial statements at the end of the year. So, but maybe first of all, you can ask yourself, what are listed companies? Listed companies are basically those companies whose shares are trading in the securities exchange market. Like in Kenya, we have so many listed companies. We have a company like what? Safaricom is a listed company. Kenya Commercial Bank is a listed company. Equity Bank is a listed company. All these companies at the end of the year, they are required to prepare financial statements, which will be published. Published means that once those financial statements have been prepared, they will be made available to the shareholders, including the members of the public. That's why we refer to those financial statements as the published. They will be made available to the members of the public. Now, when the listed companies are preparing their financial statements, which are then to be published, those financial statements should be prepared in accordance with this particular standard here, International Accounting Standard number 1. And therefore, in this case, we can say IAS 1 basically prescribes how the listed companies should prepare the financial statements for publication purpose. And therefore, this particular standard 1, it basically prescribes what a complete set of the published financial statements should contain. And number 2, how should those particular financial statements be prepared? Maybe first of all, we can look on what is contained or what should be contained in a complete set of the published financial statements. Remember, we have said published financial statements are financial statements to be prepared by listed company for publication. Now we are saying a complete set,